What's going on, you guys? Welcome to the video. My name is Brandon. In today's video, we're going to be taking a look at 3 stocks that I will personally be buying in 2019. So slightly different from our 3 stocks to buy series, where we kind of highlight like 3 stocks that I believe are currently looking attractive. These are 3 stocks that I'm actually planning to go out and buy over the coming year. So we will go into a little more detail and kind of just take a dive into my thought process into why I'm buying these stocks, and hopefully give you guys, some nice investment ideas to look into. Just keep in mind, as always, that this is not financial advice. I'm not telling you to go out and buy these stocks. I'm just sharing with you guys why I'm buying these stocks. Always do your own research when it comes to stock picking and investing. I'm making this video for strictly information and educational purposes only, just trying to give you guys some investment ideas. And lastly, before we start, I will just say that if you do enjoy this video and if you want to see more videos like this, please do give the video a thumbs up. It really does help support the channel, helps get these videos more exposure, and I really do appreciate it. So let's try to get this video to 100 likes. But let's talk about the first stock that I will personally be buying in 2019. And I hate covering like the really popular stocks on here on the channel, because I know that they're so heavily covered on YouTube, but this is a stock that I just can't resist on right now, guys. It's the company Alibaba, ticker BABA, and it trades on the New York Stock Exchange. And I actually just took last month my first position in Alibaba. So it was the first time I'd ever bought the stock. I took an entry-level position, so I do own the company, but I absolutely plan to build up my position over the coming year. And before we dive into the details regarding Alibaba, we can take a look at the share price here. I mean, this stock has been absolutely hammered. It's down about 25% off of its June highs. But let's understand here, guys, that this isn't just Alibaba. We've been seeing weakness across the entire Chinese market. And if we had to kind of put our finger on, what is the cause of this, there's always multiple factors that come into things, but clearly one of the major factors involved in this downslide is the ongoing tension between US and China with the trade wars and the tariffs and whatnot. And although Alibaba is a company that's, maybe not directly impacted by these tariffs, at least compared to some other companies, when there is negative sentiment or just this uncertainty and investors are, for the most part, pessimistic, it's completely understandable that we'd see decline or drops just in the broader Chinese market, or any market that we're talking about for that matter. And as we can see by looking here at the Chinese index, the ticker that we're looking at here is MCHI. It's basically just a broad representation of Chinese stocks. I mean, Chinese stocks in general have been on the decline or in bear market territory. And despite how difficult it is to buy into this weakness, this is a strategy that I absolutely love doing, especially in the case of a company like Alibaba, because as we'll look at in a second, like the company itself is performing very well when we look at the growth numbers, especially relative to its size, but the weakness that we're seeing is more macro or more like broad. And in my opinion, what that does is it represents a nice opportunity to pick up some of these different companies if we're willing to wait it out for the long term. And I'm almost certain that you guys are familiar with the company Alibaba, but for anybody that isn't, Alibaba is, of course, the massive e-commerce player over in China. And very similar to Amazon, like the core of their business is e-commerce. So Taobao is one of their platforms. It's kind of like their eBay, where consumers can sell to other consumers. We have Tmall, another huge platform for them, where you'd go to get more of your branded goods, say your Nikes, Adidas. They're involved so heavily in the e-commerce space, but as well, they're involved in so many other businesses, like the payment processing field with Alipay. Alipay is like the leading payment processing system there over in China. I don't know about you guys, but where I'm from over here in Vancouver, man, I see Alipay everywhere, like at the 7-Elevens, at the stores. Alipay is very, very huge, along with WePay, Tencent's payment system. But they're also involved in the cloud computing space, video streaming, program called Youku Tudu. It's the 3rd most popular platform over in China. It's growing at a nice clip. When we take a look at their paying subscribers, just a massive, massive company. Now, why do I think that Alibaba is a good stock to buy, and why am I going to be buying it going into 2019? First and foremost, like, I believe that this company is positioned extremely well to be benefiting from a lot of the trends that we're seeing in our society. The first and most obvious, in my opinion, is the increase that we are seeing in online consumption. The company has over 666 million monthly active mobile users. That's up 32 million users from the previous quarter. And as technology advances and people become more comfortable with spending online, like Alibaba and companies like Alibaba, they're just sitting here, man, waiting for this big wave of customers and money to flow their way. The second trend that I believe is going to be working in Alibaba's favor is that, although the Chinese stock market is down, China itself, like the Chinese economy, is one of the fastest growing economies out there. So don't get those two confused. And as in particular, the middle class in China rises as a resurgence of the middle class. Like, historically, I don't know if historically is the right word, but, back in the day, there was a very strong divide between the Chinese upper class and then the Chinese lower class. But as time has gone on, there's this, surgence, or there's this uprise of the Chinese middle class. And as the middle class start to earn more consistent and stable incomes, well, there's also going to be more spending out of the Chinese middle class. So that's going to be a major benefit for any retailer over in China. Lastly, globalization is a trend that very much works in Alibaba's favor. And Alibaba is a company that's not only present in China, like, I know for a fact, my brother who lives here in Vancouver, he is constantly ordering things off of AliExpress, like the most random things. I don't even know what he orders off there, but just really the most random things. Over here in Canada, people are constantly ordering things here in the States. They just have this global presence. They're shipping packages and products all over the world. They just acquired a company called Lazada. I say just acquired, but they recently acquired a company called Lazada, which is an e-commerce company that gives them exposure to Southeast Asia, places like Indonesia, Malaysia, the Philippines. Just a very, very nice footprint across the globe. Taking a look in their most recent quarter, the company grew their overall revenues by 54%, which is outstanding to me when you think of how large this company is. Like, this is one of the largest companies in the world. Their cloud segment, which I touched on earlier, that revenue is up 90%. They've been seeing some pretty significant growth in this segment year after year. In fact, if we look here at the revenue breakdown across the board, I mean, this company is showing growth across all segments. So the core of their business, which is of course the most important part, the e-commerce platforms, that's up 56%. Like I said, cloud computing space up 90%, digital media and entertainment. This would of course include their Yoku platform, other sources of entertainment and media, that's up 24%. Innovation initiatives up 20%, up for a total of 54%. So very, very promising numbers with the company despite the share price being down. And what I really do like about this company, like I said, very similar to Amazon, they are just becoming so widespread, and they're essentially evolving into this technology conglomerate, which has the ability to reach so many consumers in so many different ways. And sometimes that can be a bad thing. If a company gets too widespread and they kind of lose sight of their core focus, that sometimes can be bad for a company. But with Alibaba, I do think that they have actually very strong leadership despite Jack Ma stepping down. And Jack Ma was the founder of Alibaba. He of course played a crucial role in building up the company, but he did make the announcement earlier this year that he would be stepping down from his leadership role. And a lot of people do make the mistake of calling Jack Ma the CEO. He's not the CEO of this company, all right? He's been sitting as the executive chairman, and the CEO has been a guy named Daniel Zhang. He's actually been running the show now for the past few years, and he's done an amazing job. So the fact that Jack Ma is taking a step back, that does have some investors concerned, but it doesn't concern me at all. The leadership, in my opinion, still has a very strong and decisive vision for the company, and of course Jack Ma is still going to be playing a role with Alibaba. At the end of the day, when I see a stock, like a major stock like this, that's down this much, that does kind of pique my interest to kind of like dig a little bit deeper and see whether this is a nice buying opportunity. And in the case of Alibaba, at least by looking at the numbers, the company looks to be performing very, very strong and growing at a very nice pace, especially for such a large company. And like I said, I do believe that this weakness is more broad or more macro driven. We do just have to, of course, keep in mind that when we're investing in a company like this, in particular, like a Chinese company or a foreign company, there are always going to be risks attached. We take this political risks that we're seeing right now. And as long as we see this tension between the US and China continue, we have to expect that we may continue to see volatility with the share price. However, at the current price, I am seeing some very nice value here into a very nice growth stock, assuming you're willing to hold it for a while, wait out this tension. But like I said, I did take my initial position. Morningstar currently has them rated as a 4-star buy with a price target of $240. The stock is currently trading for $160 USD. It does not pay a dividend, but Alibaba is the first stock that I will be buying in 2019. Moving on to the second stock for this video, and it's one that I actually just covered in my 3 stocks to buy in December video. It's the company General Mills, ticker GIS. And I hate to go and kind of repeat myself here, but again, these are 3 stocks that I am personally buying, and I didn't want to just throw one into the video because, it was an interesting stock or because I hadn't talked about it yet. Like, these are 3 stocks that I'm personally buying, and General Mills happens to be one of them. And I actually do own shares of General Mills. I've held it for a number of years now. It represents, kind of a smaller portion of my portfolio. But what I'm going to be doing here is looking to average down on my position. And if you guys are interested in kind of knowing exactly when I do purchase these stocks, at what price, taking a look at my entire portfolio, you can join our private membership group. That is that first link down in the description below. But one thing that you'll notice with my investment style is that I could care less if a stock that I own goes down. And I know that that's hard to believe. I think of a company like GE as another, good example of this. For those of you guys that have been asking, I actually am planning on doing a video on GE and just recapping my 2018 picks. That video will probably be out like a month or so from now. I'm probably gonna wait till the new year, but I'm really excited for that video. I think that video will give you some really good insight into the way that I invest. But when a stock goes down, whether that be GE or General Mills, as difficult as it is to do, what I like to do is I try my best to kind of take a step back and ask myself the question, is this company going to be around in 20 years? And in the case of both General Electric and General Mills, I think the answer is yes. I think people still gotta eat their cereals and their yogurts. I think, airplanes are still gonna need their engines. I do believe that these companies are gonna be around 20 years from now. And if that's the case, if I truly do believe in these companies, I want to be going in and buying shares for as low of a price as possible. So it goes against like every gut feeling that you have and all the emotions that you're feeling. It sucks to buy a stock and a year from now you see it down 15% or 20% or 30 or 40%. But if you can take a step back and think about it logically, we want the share prices to be coming down so we can be buying in at a more attractive entry point. And it's very, very easy to get sucked in with the short-term mindset because all your emotions are kind of telling you otherwise. Nevertheless, moving on to the company General Mills, this is a stock that's currently yielding 4.63%, a very strong dividend paying stock. In fact, they've actually paid out uninterrupted dividends for 120 years in a row. Just a very reliable company in terms of income. And that's what you can expect when you own some of the world's most popular cereal brands and breakfast foods. General Mills is the company behind Cheerios, Cinnamon Toast Crunch, Betty Crocker, Yoplait, Old El Paso, just a huge list of brands. And as I mentioned in my previous video, the stock has lost essentially 1/3 of its value over the course of 2018. And at this point, I do believe that a lot of the negativity has been priced in. And I think that there is far more upside potential than there is downside. Morningstar does currently have them rated as a 5-star buy with a price target of $58. Now, just a quick breakdown on the company. They got a very, very diverse lineup from snacks, cereals, convenient meals, yogurts, ice cream. They're the company that owns Haagen-Dazs, doughs, baking ingredients, just an absolute staple company. On the right here, we do see a breakdown of their revenues by geography. So about 2/3 of the company's sales are done within the US, North America, I should say, within North America, but they do have some nice exposure over to Europe and Australia, Asia, and Latin America. So very positive in my mind when you see at least a bit of a global reach that this company has. And consumer staples, as you guys know, is one of my favorite sectors to invest in. They're almost always yielding high dividends, which is great. And when the next recession does come around, I mean, people still gotta go, they still gotta go eat their cereals, they still gonna go out and buy their yogurts. You could even make the argument that these companies actually benefit from a recession because people are less likely to go out and, spend on a nice night out or go out on a nice dinner. They may just go buy these groceries and just eat at home. So General Mills would definitely be a good example of a recession-proof stock. The one thing that we talked about in the previous video was their acquisition in April of the pet foods company Blue Buffalo. Blue Buffalo is one of the strongest and most recognizable pet foods brands in the US. I really do believe that this was a strong acquisition for the company. It really fits, their core product line and just gives them one more recession-proof or non-cyclical division. And again, I really do hate to repeat myself here because I know that a good chunk of you guys watching very well may have seen my previous video. So if you're interested in hearing more of my thoughts on the company General Mills, I will include that previous video down in the description below, so be sure to go check that out if you haven't seen it already. But I did want to show you guys a clip here taken from their investor relations page. It's a clip showing a 150-year history of General Mills, and some of you guys may find this lame, but it is very short. It's only 50 seconds long, so let's just have a quick watch of this. And I hope that that wasn't too lame and too boring for you guys. But, the reason I wanted to show you that was that, this company has been around for a long time, okay? They've seen it all. They've gone through the Great Depression, World War II. There's been numerous periods of times where the company's been facing struggles, whether that be, economical struggles or whether that be with the business itself. But they've been able to work through that and still build up some of the most recognizable brands in the world. So you could absolutely make the argument today that, the consumers are changing, they're trying to be more health conscious and that's not good for the company. You could talk about like debt levels rising with General Mills, which they absolutely are, but General Mills has proven themselves for decades and decades and decades. And I'm very confident that the company's going to be able to work through whatever struggles they're facing right now. I mean, they've been through it all. And with the stock being down over 40% off of its highs, at some point you got to start seeing value here with a company like this. And I'm going to be more than happy to continue buying this stock through 2019. The stock currently trades for $42 USD. It trades at a PE of 15 and it pays a 4.63% dividend yield. Moving on to the third and final stock that I'm going to be buying in 2019. This one goes out to my Canadian viewers out there. It's the company Bell Canada. And for anybody that's not from Canada, maybe you're from the US, don't stress because this company also trades on the US exchanges. It trades on the New York Stock Exchange under the ticker BCE. And of all the Canadian stocks that I would consider personally, if I were from the States, Bell Canada would definitely be towards the top of that list. Bell Canada is the largest network provider here in Canada. They offer wireless network, internet, broadband, TV, landline services. They serve over 9 million customers. They're just one of the major companies here in Canada. And I actually did talk about this stock a couple months back on the channel with our Canadian version of 3 stocks to buy. That was in October. And the stock had been down about 18% on the year. And as we can see from the graph, like the performance over the past month has been very, very nice. So pretty much right after I posted the video, you guys must have seen it. You guys must have gone out and started buying up the stock. And I guess you could say we're moving the markets over here. Now, why do I think that Bell Canada is a good stock to buy? And what I find very enticing about the company is that it's very interesting because here in Canada, in the telecommunications space, the top 3 providers, so that would be Bell, Rogers, and TELUS, those 3 providers combined, they control approximately 90% of the revenues in the Canadian telecommunications space. So they have complete control over this industry. And to be completely honest with you, whether we're talking about Rogers, TELUS, or Bell, I think all of these 3 companies are companies that I'd be comfortable holding. However, of the 3, Bell is hands down my favorite choice. They are the largest of the 3 providers with a market cap of $51 billion. And despite being the largest in size, they trade at the lowest PE, currently at 18.7, and they pay a 5.3% dividend, so substantially higher than its peers. And to be able to invest in a company and pull in a 5.3% dividend yield is amazing, especially when we factor in that, the telecommunications space is kind of known to be a very reliable dividend paying sector. When you think about people paying their phone bills or for their internet, that for the most part is pretty reliable. However, like a lot of these high dividend yielding sectors, this company has been under pressure from rising interest rates. And again, guys, when interest rates are rising, which they have been, what that means is that bonds and these other fixed income type assets, they're going to be paying out higher and more attractive coupons or higher yields. And as these safer yields are rising, what we'll see is a lot of investors kind of cycling out of their dividend paying stocks into these safer assets. Now, good news here for Bell Canada is that although rates are going to continue to rise, I think they're going to be rising at a bit of a slower rate. So we will start to see these bond yields kind of taper off. We can take a look here at the company's recent earnings report. They just reported in early November. Things were looking pretty good. In the third quarter of 2018, they were able to grow their revenues by 3.2%. And I know that sounds like nothing compared to a company like Alibaba that we just looked at, but we got to keep in mind, guys, these are 2 very different types of companies. They added a record high wireless net additions of 178,000. Net income was up 2%. The company is just kind of trucking along steady as she goes. And of course, right now, the big thing that's going on for them is the rollout of their fiber optic network. I know at our firm, just last week, we had some TELUS workers. They were in there, installing the new network at our office. This is, of course, the fastest and highest quality internet service available to the market right now. Not too long from now, we are going to be moving on to the 5G network, which is, of course, going to be huge for, not only Bell, but the entire industry. At the end of the day, I'm buying this stock because I'm just looking for like a nice core position to hold in my portfolio that I can hold for years and years and years to come. And when I look at my options here in Canada, I kind of look at like the banks, these big 3 providers. They're all just a really nice piece that I can add to my portfolio. And to be able to pull in, like I said, that 5% plus dividend yield with the potential for capital appreciation, I think that Bell Canada is just an outstanding choice. The stock currently trades for $56 Canadian, and it pays a 5.3% dividend yield. So guys, those are 3 stocks that I will personally be buying in 2019. Like I said, I'm by no means telling you guys to go buy these stocks. I'm just sharing with you guys what I'm going to be buying. What do you think of my stock picks? Do you like the picks? Are you maybe considering buying some yourself? Do let me know in the comment section below. And like I said, if you are interested in keeping up with exactly when I do purchase these, the prices that I get in at, be sure to check out the membership group. That's that first link in the description below. And if you did enjoy the video, you can feel free to give it a thumbs up. If you're not already subscribed to the channel, I post a video every Monday, so subscribe and make sure you hit the bell for notifications. But as always, guys, that'll wrap up the video. I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.